Hello everyone. I'm Keigo Fuchi from Chuo Law School. In today's class, we will explore the evolution of the Japanese tax system through its changing definitions of income for taxation purposes. The income tax was first introduced in the United Kingdom in the late 18th century. By the 20th century, it had become a major source of public revenue, particularly due to the fiscal demands of the world wars and the expanding role of the state in social policy. However, the definition of income has varied significantly across countries and historical periods. Broadly speaking, the scope of taxable income has expanded over time. Nevertheless, many forms of economic benefit remain untaxed or are subject to minimum taxation. This class will address two main topics. First, we will examine the conceptual development of income and its influence on Japanese tax scholarship. Second, we will analyze how Japanese income tax legislation has broadened the scope of taxable income, while still exempting or lightly taxing certain types of income. The structure of the class is as follows. We will begin by presenting a taxonomy of income concepts, providing a framework for understanding and categorizing various definitions of income. Next, we will trace the historical development of the concept of income with particular attention to its evolution in the United States, Germany, and the United States, and Japan. Finally, we will examine how Japanese income tax laws have gradually eliminated non-taxable categories of income, thereby expanding the tax base. We will also highlight the limitations of the current legal framework, which continues to exempt or lightly tax certain types of income. Today, we will examine the scope of income that may be subject to taxation under the income tax system. The concept of income is used for other purposes as well. For example, in macroeconomics, the concept of national income is used as a measure of a country's economic activity. However, we focus exclusively on how income should be defined as the object of income tax. The issue of defining income or determining its scope as it pertains to income tax has traditionally been discussed in the field of tax law and tax policy as the issue of the concept of income. The concept of income can serve as a guideline for designing the income tax system and for interpreting existing income tax statutes. In system design, legislators write provisions for taxable conditions based on the assumed concept of income. When there are ambiguities in the provisions for taxable conditions, interpretations is guided by the concept of income. For example, Article 35, Paragraph 1 of Japanese Current Income Tax Act subject to taxation as miscellaneous income, any income that does not fall under interest income, dividend income, real estate income, business income, salary income, retirement income, forestry income, capital gains, or temporary income. Whether a such person's earning qualify as a miscellaneous income is determined based on the concept of income assumed by Japan's Income Tax Act. The various types of income that have been proposed so far can be categorized into at least four types. First, as traditionally adopted in the United Kingdom, the birthplace of income tax, there is the view that income is something that arises periodically from capital. Second, as was common in 19th century Germany, there is the view that income is the regular profit of a person earns. Third, as proposed by Georg von Schantz in late 19th century Germany, and later by Robert Hale and Henry Simons in early 20th century America, there is the view that income is the total sum of all benefits a person receives. Fourth, as argued by Irving Fisher in the early 20th century, there is a view that income is nothing other than the economic value a person consumes. Among these, the first view does not focus on the individual at all. In contrast, remaining three focused either on the inflow of economic value to a person or the outflow from a person. The second view clearly captures income as a point of entry. It assumes regular income, such as sales from business activities. Of course, income is conceived as the difference after deducting expenses from revenue, not as revenue itself. However, the starting point is the inflow of economic value to the individual. In contrast, the fourth view clearly captures income at the point of exit. The economic value a person obtains by some means is ultimately used to purchase consumer goods. This view seeks to grasp income at the stage of consumption of that economic value. So what about the third view? It can be said to capture income both at the point of entry and at the point of exit. It conceives income as the total economic value flowing to a person minus the cost incurred to obtain it. Thus, it can be seen as focusing on the entry point. However, according to this view, income can also be defined as the sum of the increase in the value of a person's wealth over a year and the economic value used to purchase consumer goods. Such a definition reflects on a person's economic activity after the year has ended. So it could be argued that this definition captures income at the point of exit. Income tax was first introduced in the United Kingdom in 1799. It was established under the leadership of then Prime Minister William Pitt the Younger, with the aim of raising funds for the war against France. Existing taxes were insufficient to cover the cost of war, so a new type of tax, income tax, was conceived. The 1799 income tax was levied on individual income at a progressive tax rate. However, it did not generate as much revenue as expected. This was because, out of respect for public sentiment at the time, which was averse to tax investigations, taxpayers were allowed to self-report their income, and the investigative powers of officials were extremely limited. In essence, the system was designed based on the assumption of good faith. As a result, tax evasion became widespread and the government was unable to effectively crack down it. Pitt's income tax was abolished in 1802. In 1803, a new income tax was introduced by the next Prime Minister, Henry Addington. Although it bore the same name, this new tax was based on a fundamentally different concept from Pitt's version. Addington's income tax was based on the schedular system. Income was categorized into 5 schedules, and tax was levied according to method specified for each category. This system continued to be used in the UK's income tax system. Although income tax was once again abolished in 1816, it was revived in 1842 under the second Robert Peel administration, which also adopted the schedular system. Specifically, the schedules were as follows. In Schedule A, rental income from real estate was taxed through withholding at the source. In Schedule B, agriculture profit were taxed by assuming a certain percentage of rent paid by farmers to landlord as profit. In Schedule C, income from governmental investments, for example, bonds, was taxed through withholding. In Schedule D, profit from commercial and other business activities were taxed based on assessments by officials. And in Schedule E, salaries and pensions were taxed as compensation for labor, or also through withholding. The UK's income tax system, based on the schedular system, focused not on individuals, but on capital as the source of income, and only recognized recurring income from capital as taxable. This can be explained in 3 main points. First, the most important feature is that under the schedular system, an individual's total income is not necessarily considered. Questions like what is a person's income or what is its scope are not addressed. This is evident in Schedule A, C, and E, where taxation occurs without identifying a recipient of the income. Second, under the schedular system, gains not falling under the enumerated schedules are not subject to taxation. For example, Schedule A taxes regular payment like rent to landlord. If a landlord gains profit in another form, it is not taxed. This raises concerns about fairness, especially when similar economic gains could be obtained through untaxed method. Third, the schedule system conceptualizes income as something that is regularly generated from capital. Therefore, fluctuations in the value of capital itself are by definition unrelated to income. Unlike in the UK, in Germany, the concept of income is fundamentally based on a focus on the individual, and that a broad interpretation of income has emerged from this perspective. Contemporary German Income Tax Act divides taxable income into two categories, each grounded in a distinct principle: net wealth increase theory and source of income theory. The first category includes income from business activities as listed in Section 2 of the Income Tax Act. These are taxed based on profits, which are calculated not only by subtracting expenses from actual revenue, but also by reflecting changes in the value of assets used in the business. This principle is the net worth increase theory. The second category includes income from non-business sources, such as employment and investment, listed in Section 212. These are calculated by subtracting expenses from actual revenue. This method is justified by the source of income theory, which, like in the UK, treats income as something separate from capital, and only such separate income is taxable. So how did German income tax originate? Let's examine the tax system of Prussia, one of the states that formed the German Empire in 1871. The precursor to income tax was the 1811 head tax, which imposed a fixed tax on individuals living outside cities, regardless of wealth or social status. To supplement revenue, the 1820 class tax was introduced. Class tax. This tax was based on social class and approximate wealth with 12 tax brackets combining 4 classes and estimated asset or wealth level. But after a failed attempt to introduce income tax in 1847 and 1849, a major change occurred in 1851. The highest class was removed from the class tax and taxed based on actual income using a progressive tax rate. In 1873, low-income individuals were exempted from the class tax, effectively abolishing the head tax. However, the system still failed to accurately capture individuals' income. To address this, the 1891 Act was enacted. The 1891 Act abolished the class tax and unified various systems of individual taxation into the income tax. It required individuals earning over 3,000 marks annually to declare income in 4 categories. 1. Income from investment capital. 2. Income from real estate. 3. Profit from business activities. And 4. regular income, such as salaries and pensions not covered by the above. This detailed reporting was necessary due to the final tax bracket introduced. After World War I, the authority to levy income tax in the German Empire was transferred from the individual state to the federal government. The Reich Income Tax Act enacted in 1920 regarded income as an increase in the value of one's wealth per million. That is the total of various properties attributed to a person, without questioning the source of the income. Thus, this act was based on the concept of the net wealth increase theory, which had been formulated by the economist Georg von Schantz. However, the subsequent Reich income tax of 1925 partially revived the source of income theory, which had been adopted in the 1891 Income Tax Act, alongside the net wealth increase theory. As previously mentioned, even today, both the source of income theory and the net wealth increase theory serves as fundamental principle of German income tax law. Let's go to the part of the United States. It may be surprising considering that the United States became a global leader in economics in the latter half of the 20th century. In the early part of the century, many American economists studied in Germany to learn the latest theories. Robert Haig and Henry Simons made significant contributions to the American understanding of income in such an era. In his 1921 article, Concept of Income, Robert Haig was the first in the United States to propose a broad definition of income. According to him, income is the money value of the net accretion to one's economic power over 2 points in time. This definition resembles that of Georg von Schantz in Germany. Both focus on the individual and on changes in economic power over a period. Both also define income in relation to income tax. However, it's unclear whether Haig was directly influenced by Schantz or other German economists. Schantz emphasized the concept of wealth, the total economic value belonging to a person, whereas Haig used the term economic power instead. Thus, while similar, Haig's definition differs fundamentally by omitting the concept of wealth. In contrast, Henry Simons clearly defined the concept of income under the influence of German economics, including that of Schantz. In 1938, he published a book titled Personal Income Tax, in which he presented the following definition of income. Personal income may be defined as the algebraic sum of 1. The market value of rights exercised in consumption, and 2. The change in the value of the store of property rights between the beginning and the end of the period in question. In other words, it is merely the result obtained by adding consumption during the period to wealth at the end of the period and then subtracting wealth at the beginning. This definition is somewhat difficult to grasp because it defines income not at the point of entry but at the point of exit. However, in essence, it is the same as the definition of income proposed by Shantz and Hale. All economic gains a person receives, regardless of their origin, are included in income. Unlike Hale, Simon's concept of income was clearly formulated under the influence of German economics, particularly that of Shantz. In other words, Simon's concept of income not only focuses on the individual or personhood, but also aligns completely with Shantz's concept in that it is based on the idea of wealth as the total economic value attributed to a person. Simons himself stated that his concept of income was consistent with those of Shantz and Hale. He also paid close attention to the German concept of Vermögen, wealth, and proposed the English equivalent as the total set of property rights. Like Shantz's definition in Germany, the Hague-Simons definition in the United States encompassed a very broad range of income. This broad scope, combined with progressive tax rates, enabled income tax to serve as a tool for wealth redistribution and to fund social policies, especially after the Great Depression. Their definition also went beyond the scope of the federal income tax at that time. According to them, for example, unrealized capital gains were considered income. Imputed income was also included in income. However, these types of income were not taxed under the Internal Revenue Code at the time. As a result, Haig's 1921 article and Simon's 1938 book were not immediately embraced by American legal scholars. Initially, their ideas were discussed mainly in economics literature, not in legal writings. Even in legal journals from 1940s to early 1960s, their concepts were rarely treated as a unified theory. The first legal article to examine the Hague-Simons definition of income was published in March 1967 by Boris Bitka. Interestingly, Bitka did not advocate for the definition. Rather, he argued that applying it in practice was extremely difficult. Nonetheless, from that point onward, the Hague-Simons definition became a firm reference point for interpreting the Internal Revenue Code and legislating federal income tax in the United States. Let's go to the part that dealing with Japan. After World War II, Japan's income tax system was heavily influenced by the United States. In particular, the 1950 tax reform based on the 1949 Sharpe recommendation significantly reshaped Japan's tax laws including the Income Tax Act. American influence extended to academic discussion as well. Papers by American economists on income tax were translated in Japanese and used as references by the Tax Bureau of Ministry of Finance. The Sharp recommendation in 1949 suggested establishing tax law courses in major Japanese universities. In response, in response, institutions like the University of Tokyo and Kyoto University began training tax law scholars. One such scholar, Keiji Kiyonaga of Kyoto University, made his academic debut in 1958 with an article titled Shant's Net Wealth Increase Theory. By the late 1950s, the income concept proposed by Shantz, Haig, and Simons had become known in Japan. However, they were not yet considered the sole guiding principle for interpreting Japan's Income Tax Act. Instead, they were seen as one of several perspectives on income. However, Hiroshi Kaneko appeared as the first person who clearly asserted that the broad definition of income proposed by Shantz, Haig, and Simons should serve as the sole guiding principle for interpreting and legislating Japan's income tax law. He submitted this idea in his three-part article titled The Composition of the Concept of Income in Tax Law, published in 1966, 68, and 75. Born in 1930, Kaneko was, like Kiyonaga mentioned earlier, one of the first generation of tax law scholars in Japan. He debuted in academia with a solid comparative law paper on the constitutional doctrine of political question in the US, UK, and Germany, and France, initially focusing on constitutional and administrative law. After studying law in the United States at Harvard from 1961 to 1963, Kaneko emerged as a leading figure in Japanese tax law. In his article, Kaneko named the definition of income by Shantz, Haig, and Simon the comprehensive concept of income, arguing that Japan's income tax should be interpreted based on this concept and that it should guide legislative efforts. By rejecting the source of income theory and advocating for the net wealth increase theory, equated with the comprehensive concept of income, and the sole principle to be referenced, his article was groundbreaking. Kaneko pointed out two main reasons why a broad concept of income, that is the comprehensive concept of income, or net wealth increase theory, should be adopted. First, from the perspective of fairness in the distribution of tax burden, it is desirable to adopt as broad a concept of income as possible. Since income of the same amount provide the same benefit to a person regardless of how it is obtained, it is undesirable to exclude income and through a specific means from taxation or to tax it at a lower rate. Furthermore, in relation to applying progressive tax rates to achieve redistribution, it is also preferable to define income broadly. Second, to make income tax better fulfill its function as an automatic stabilizer, it is desirable for the scope of income to be broad. In discussing fairness, Kaneko emphasized that income tax is a tax on individuals. He stated, the most important thing in constructing the concept of income is to clarify the nature of income. As Simon said, the personal income tax is not a tax upon income, but a tax upon persons according to their respective incomes. The issue is maintaining fairness among people, which is achieved by including as comprehensively as possible the gain that increase one's ability to pay. Though it may sound abstract, I want to point out that income is not a concept tied to things, but to a person. Business profit, rental income, interest, and wages are often referred to as income. This understanding is not incorrect, but these are merely phenomena of income. The significance of income lies in the fact that these gains belong to specific individuals and increase their ability to pay. Therefore, any gain that increases one's ability to pay should in principle be considered income. This passage shows that Japan favors income concepts that focus on individuals, unlike the UK's capital-focused approach. Among such person-centered concepts, the comprehensive concept of income, which defines income as broadly as possible, was accepted as a guiding principle for interpreting and legislating income tax law, thanks to Kaneko's influential article. Okay, this is the end of part one of this lecture. Thank you very much.